What is the point of market structure? How to determine it? What problems do beginners encounter when applying structure to a chart? Hello everyone, my name is Victoria and I'm glad to see you on my YouTube channel. In today's video, we are going to learn how to use market structure and follow a trend. I will also unlock some secrets that help identify sniper zones of interest for sales and purchases. Make sure to subscribe so you don't miss it. Let's get started. First and foremost, most people think that this is a simplified version of the structure. Basically, when the price is going up, we call, and when the price is going down, we put. Sounds easy, but not just quite. In reality, when the price starts going up, the pullback phase begins, and we don't really know how long will it last. And when the pullback phase begins, it's becoming harder to make decisions. But where will the price go anyway? Will the pullback phase continue and turn into a new downtrend, or the opposite? Will the price continue to rise and end up creating a new maximum? Let's dig deeper into all of these topics. Where the price most often pulls back, how to apply it, what optional trading entry is, how to use Fibonacci, and how to make structural points. I'd like to begin with the structural elements. There is a basic price structure element called an impulse. An impulse basically renews the previous maximum. Another important element of the structure is the pullback. The pullback could have a range of the entire impulse without any clear point where the pullback would be considered abnormal. Sometimes you see a pullback of a 20% new maximum. Then the impulse is estimated in another way. But more often than not, you will see big pullbacks like 50% and higher. And since, according to the statistics, this is the case most of the time, we already use most concepts that place the impulse at the top and the bottom as 50%. So the bottom 50% of an uptrend is called discount zones, and according to smart money concept, this is called a discount. And basically, when there's an impulse, when the price rolls back to the bottom 50% of the impulse, we are presented with a discount in order to enter at a lower level. And the upward trend will continue. In a downtrend, it's different but very similar. The top 50% is called premium. These are the best premium prices. In reality, when there's an impulse, our goal is to mark the beginning and the end of it. And very importantly, mark the pullback period. And later, we don't actually factually know whether there will be a pullback in the bottom 50% on the uptrend or not. Our task is to mark the entire impulse as a premium discount zone and market the discount zone on the uptrend. After this, in the discount zone, we watch the reaction of lower time frames, because the pullback on, for example, an hourly chart looks like this. And we realize that this is a pullback within the impulse of on the uptrend time frame. But on the 5-minute chart, a full-fledged downtrend is formed and its own local downward structure, where there are also certain manipulations we will get into later on. When the price enters a discount, we want to see exactly the moment of structure's breakdown when it turns upwards, just like we did with the structure on a higher time frame. This is called structure synchronization. Basically, this is when both the local structure, that is descending structure, become an ascending, and the global structure, ascending one, coincide and are synchronized. Meaning, in the discount part, we want to confirm the idea of an uptrend and confirm the purchase. Let's have a look at an uptrend. When it comes to gold, we can see that on the hourly time frame, we have an uptrend cycle. I'll mark this for you to see. On the 5-minute time frame, we see how prices tend to pull back. So if there was an impulse, we mark it as premium discount zone. Our area of interest is the discount. And now we see how the price pulls exactly in that zone. But on the 5-minute time frame, this is a full-fledged downtrend with updating the state of minimals and so on. At some point, the structure changes and the maximum is updated as well. And now the structure is synchronized. And on the 5-minute chart, we see an ascending structure, and on the hourly chart, the structure is also ascending. That is called synchronization. Now let's discuss what points should be marked so that the structure is as objective and correct as possible, meaning that if you have an impulse that has not updated the previous maximum, there was a different impulse or no impulse at all, because updating maximum or minimum is exactly what the impulse does. This is the impulse's task. So an impulse is a notion that updates the maximum or the minimum, that's all. It's quite easy to understand. I will now show you an example. Today we will follow everything with an example. So we have this part of the graph. Let's break it down. There is a certain maximum that has been updated by the price. We will consider the entire movement from minimum to maximum as an impulse. And if you see within this impulse, there is already a pullback. Inside this impulse, there is what seems like an upward impulse, but if it does not update this maximum, this is not an impulse. It's just a volatile candle. And we look for the beginning of a new impulse, which updated the current maximum. Again, we do this in order to objectively determine the premium discount zone and potential pullback zones. There is a minimum point where the line starts going up, a pullback begins, it adjusts to a discount, after which the price begins to go up again. There was a strong pullback here before the maximum update, and here begins an upward movement without any pullbacks. The pullback begins again and the upward movement begins again. In my opinion, it is not complicated at all, and if you see this, you can identify impulses and pullback points on the chart yourself. This will help you understand such structural elements. Now let's see how it looks in a lower time frame. On the lower time frame, we often have stops, false breaks, and so on. And in order not to get confused, the structure here should be marked precisely at key points. So basically, when the price is going up and is updating the maximum, you can note that the structure is ascending and mark the minimum points from which the maximum update occurred. As soon as the price begins to go down, we also mark the maximum points from where the minimum was updated. For example, here we have a minimum from where the price is updated right here. In order not to get confused, you don't need to mark like every single notion. The price updated it, we have a new minimum. You should have clear pullback zones where you can consider buying or selling. This makes trading so much easier. Here we have the current minimum from where the price updated it, right about here. The current minimum, the price updated it from here, and consequently, at some point, the price stands in the range and essentially just doesn't give any reaction. We just have a range. The minimum was updated from this point here, and we have a range of this downward price corridor where the range is, where the price was going down previously. And if we see an upward movement followed by a pullback, then obviously our structure will change. I would like to specify that you absolutely don't need to mark every single candle. It is much easier to trade with structure. Now let's look at how to apply PD at a more advanced level. This is the Fibonacci grid. If we have some kind of impulse, its completion, the beginning of a correction, you can mark the beginning and end of the impulse in the Fibonacci grid. Use these settings, 0.7 and 1. You may wonder why that is. Well, according to the statistics, if the price rolls back to the discount, that is to the lower 50%, most often it will test exactly at 0.7 or 0.61. And I mostly focus on 0.7, but 0.61 is also tested quite often. So why do we do this? According to the same statistics, this is the most profitable price to turn around and continue moving up. Again, if you have a down impulse, what exactly is going on here? We also simply mark the upper 0.7 and wait for the price to test. This is where it most likely reverses. And if you look at the chart, this happens not very often, but it does happen not very often because it is so effective. So if we get this, it works 100%. Let's say we had an impulse. We marked the beginning and end of it, but the price did not reach this zone. This is okay. Let's see where the new impulse came from. We also note the beginning and the end of the impulse. Again, the price did not reach. That's okay. If the price reaches, for example, like you see here, the beginning and end of an impulse, we see just the perfect developments. Therefore, you can mark both premium discount zone and the Fibonacci grid with values 1, 0.7 or 0. So if the price tests 0.7, this will be the perfect opportunity to enter the deal. Or the opposite, for example, we have a certain impulse, you can note both premium discount and Fibonacci. But if the price reacts to neither 5 nor 0.7, this is a huge probability that the trend has broken down and it's definitely not the best time to call. I would like to take a second and ask you to subscribe to my Telegram channel. There you will find a lot of useful information and frequently asked questions. The link is in the description below. So let's summarize today's video. We discussed the basic principles of trading according to market structure. We discussed the basic principles of trading according to the market structure. We looked at ways of determining the structure and what problems beginners may encounter when applying this knowledge to practice. We discussed different pullbacks and how to determine discounts and premium zones. We also looked at how important it is to synchronize the global and the local structure in order to confirm a trading idea. Using charts as an example, we saw how prices pull back and how we can determine the impulse and the discount zone to make a decision about entering a deal. It is important to remember that the structure trading requires careful analysis and understanding of price movements over different time frames so that you could be successful in making trading decisions. I really hope this video will help you better understand this approach to trading. Like this video and I'll see you in the next one. Bye!